Welcome back to In the Harbor, the podcast where sports, leisure, and finance meet. Today, I promise we're going to talk about all three of those things as we have a wonderful guest. Sean, who do we have on today?
Well, we're lucky to be joined by Ashley Marks, a great friend of mine from several years back. Not several years back. Let's not be crazy here. You know, a few years back, right? Michigan, 90, you're 98?
I'm 98.
Yeah, I'm 99. So not too long.
So you're much younger.
Just a quarter of a century ago.
Yeah, well, whatever.
Yeah.
When you put it that way, it doesn't sound...
It's rounding, Jason.
Details.
That's right.
So Ashley was a captain of the soccer team back in the day in Ann Arbor, and we hung out a lot and kind of reconnected recently because we're both in the investment world, which is great, and has followed a similar path to some of the other people we've had on In the Harbor, and we're really excited to have a story today or share her story today.
All right. So Ashley Marks, co-founder of Cordillera. Welcome to the pod.
Thanks. Excited to be here. We could do a sidebar on Sean later if anyone wants that.
I think we have some room for that.
No, it's a very busy agenda we have here today.
Get some good clips.
There's always time.
So Ashley, I'd love to start it out with kind of your entire career arc. So we can go back to undergrad days at Michigan, go blue, and then from there kind of soccer team to Stanford, and we'll go on.
Yeah, perfect. Always happy to go back to the glory days at Michigan. Came out of Denver and went to University of Michigan, and frankly, the reason I chose it is because it had the right combination between academics and athletics, and frankly, both my parents went to Ohio State, so it pissed them off. So that was kind of the trifecta. But Michigan did not disappoint. Ended up making lifelong friends and learned a ton while being there. So I knew I wanted to actually major in finance. So how it works there is you go, and I actually don't think it works this way now, but when I was an undergrad, you would go and you would apply to the business school. So, and you entered in your sophomore year. So I did that with having soccer as the extracurricular. So needless to say, was fairly busy, and also sorority, but not many people knew I was in the sorority, including most of the people in the house that I lived in. So I was a little busy, but I always found time to get to Rick's or touchdowns on Wednesday, which was equally as important.
Sundays at Dominic's was key for me. I felt like Sunday was a good day.
And
those were good. Sangria Sundays,
yes.
we call
them. Sean told me he chose Michigan for academics and athletics as well.
That's usually the go-to line, you say,
Yeah.
So look at the soccer team. Obviously, the soccer team was a great experience for you. I was curious, when you became captain, was that a team vote or was that a coach vote? Do you remember?
Well, I remember it well. It ends up being a team vote, thank God, because I'm pretty sure my coach would not have chosen me.
That's so
good. There was, I guess, I don't know if you call this a wrinkle, but I think it informed probably the rest of my life. But I went to Michigan. It was my freshman year, and the team just became varsity that year.
Right.
And so there's someone behind me. So.
Oh yeah, taking pictures.
Yeah, just little creepers behind me.
Denver.
Yeah, it's hard to. It's hard to keep the paparazzi away.
That's so funny.
We're in Denver and it's getting cold, so that's the heat. That's the heating guy. So I went to Michigan and we just became varsity my freshman year, and so it was a whole recruiting class, and they got a great strong recruiting class, and every year from there they kind of recruited over that class, and so by the time I was a senior, I was actually sitting on the bench, which is a very humbling experience when your whole life you kind of were one of the best at something, and then year by year you start to kind of realize that you're just human and you're not the best at something. But the reason I bring that up is because it's probably one of my proudest accomplishments is actually my team still seeing value in me, even though I was not on the field all that much. And so when I got voted captain, that was kind of a moment that said to me, there's a lot of ways to contribute, and it doesn't always have to be as, the star player or a player almost at all, which I think in a lot of ways informed kind of the rest of my life. But it was a tough pill to swallow. It was one that I think probably the biggest lesson I've ever learned, and it kind of has paid for, I think it's paid dividends since then. So anyway, you asked about captain, and so I can never just say, yeah, it was great to be a captain, but because it was hard to become the captain, and I'm pretty happy that it all played out that way.
See, I've known Ashley for this long. I didn't know that story. This is
Well,
why we do
because
these
Sean,
things.
you never came to the women's soccer games.
Yes, I did. I went to a lot of the games.
Yeah, it was hard to get into them. I understand. You have to wait outside. I did not play much, but I certainly had passion and spirit for it.
The first Michigan sporting event I went to was a women's soccer match.
I didn't know that.
Is that right?
Yeah,
Oh, that's niche-y.
When I moved to Michigan, exactly.
There you go.
How'd that go? They're a good team now, actually. They weren't as good when I was there.
Well, I'm sure some of that.
My friends are listening.
Yeah. We'll just send it to a few of them.
Yeah.
When you went through that experience, though, learning to be a captain who's not playing, and there's so many, I guess, valuable things you probably took from that you can apply to what you're doing today. And it's pretty interesting looking now. But let's keep going through the history here, because it's really fascinating what you've done. So you leave Michigan, you transition into investment banking, right?
Yep, that's right. And I remember going into the career office from the business school, and I just sat down and I said, okay, I don't know what I want to do, but what's the hardest thing to do? And they said investment banking. And so that was, frankly, I mean, I did have an affinity towards finance, but I thought what was most important at that time was to create as many options as possible. And so I kind of wanted to do the hardest thing out of school, and investment banking was it. So I went to the Bay Area to do banking, which was very different than what was going on in New York, but it was really the start of the tech boom, the internet boom. And so I got some great experience right out of school at Robertson Stephens in the Bay Area. So that kind of set the foundation for the rest of the time.
Any fun accounts you can tell us you worked on? I mean, tech boom in the Bay Area had to be something.
Yeah, unfortunately I wasn't on the cool ones, but through the bank there was, it was Ask Jeeves was probably the biggest one at the time, which Jason, you might not know.
I remember Ask Jeeves.
Yeah, Ask Jeeves was pretty awesome. So Excited at Home was another one. I didn't work on either of those, but those were the big names that came out of Robertson Stephens at the time.
What a throwback on Ask Jeeves, and think how far we've come with like the large language models and
right
AI
right.
and
how
we serve.
The right thing, I guess. Yeah.
All right, so you're in the Bay Area, and then you decide again. You probably went and asked somebody what's the hardest thing to do, and you said, "I'll just go to Stanford." How did that happen? How did you end up going there?
Well, I did go to Stanford, but I went first in a very different capacity. I was in investment banking, and I will never forget. I was on a road show for an IPO, and I really respected the CEO at the time. And I said, I have this burning desire inside to coach. How crazy is it to take a year out of my career and go do that? And he gave me some pretty good advice. He said, listen, he said, you need to lean into your passions throughout life, and you're going to find your way by doing that. And so that was contrary to what a lot of people said. I knew I wanted to ultimately go back to business school. But I really had this passion to go back and coach, kind of given, and Sean, just to connect the dots here, having been a bench player, but still figuring out a way to add value. I just felt like I had a lot to give back because my experience on the soccer field had been pretty profound and forming me. And so I did want to try to go and coach. So I actually did go to Stanford. I was asked to stay as a third-year banker, and I decided, okay, I'm either going to take that job or I'm going to get a job as an assistant coach at Stanford, which I had never been on Stanford's campus. They didn't know me, and I went and knocked on the coach's door and said, you need to hire me as your assistant coach. And he said, I don't know you. Why do I need to hire you? And I said, because I have a tremendous amount of passion and I have a lot to give. And he essentially told me to pound sand, which was probably the right thing to do. But then he said, well, you can come to the camps this summer and we'll just see kind of where it goes from there. So I ended up saying no to the 3rd-year term at my investment bank, moved down to Palo Alto, started working the camps, and then they asked me to come on as goalie coach, which is also strange because I never play goalie. So I ended up coaching Stanford for a year, goalie coach, and I ended up coaching actually one of the national team players, and I had never played goalie. And that was also another humbling experience, but a wonderful year. And that team was actually, I met one of our good friends there. So I ended up coaching for a year. After that, I knew that kind of my passion was, I loved coaching, but I kind of got that out of my system. And so then I went and I had stayed in touch with the ex-CEO of Robertson Stevens, where I had worked, and he was looking for a new analyst at Stanford Management. And Stanford Management is the Stanford Endowment. And so I went and interviewed there when I was still at coaching soccer, and he brought me on as the first analyst at the Endowment and Foundation. So I was an analyst at Stanford, working on behalf of the university to invest their money. And that was the first time I went from the sell side to the buy side, and I quickly realized I will never go back to the sell side. So that's where I kind of and we could talk about Stanford and all the things that it gave me, but it gave me an insight into Stanford, which I absolutely loved, but also gave me an insight into the various different types of investing, and I started to realize that I had a passion for what this investing thing was, and then it was just about picking my spot within kind of the asset classes.
So that lean into your passions really proved to be sage advice.
I think it was, and I think if you're I would say this generation has taken that to heart and maybe a little bit too far. I think there's the reality that you still have to work hard, you still have to do things sometimes you don't like, but you're going to be much better at doing something that you're passionate about and you have a passion for. Now that can mean a lot of different things. You can be doing something that you don't totally love, but doing it with people you love. Obviously the best case scenario is doing something you love with people you love. And so I just in general know that I'm going to be much better at something where I have a lot of passion for it. And so following that advice for me was very key and something that I continue to tell others that are trying to find their way.
Okay, so we're at the Endowment at Stanford, and you're working as an analyst on how long were you in that role for? A couple of years? Was it how long?
That was a 2-year role.
2-year role.
So I was there. Yeah, I was there for 2 years.
And then you go to Makena Capital.
I go to Stanford Business School. So I essentially tried to go to Stanford as much as I possibly could. So I did the coaching for a year. Then I went to work at the Endowment. And being around that place, it kind of gets in your blood. And so I said, my dream here is to go to the graduate business school. And I was lucky enough to get in because it does take quite a bit of luck at that point. And so I did my 2-year MBA at Stanford, and that was a dream come true. I felt like I was definitely punching above my weight, being amongst the people there. Every person I met there was smarter than the next, and just incredible stories, incredible people. And so that was a 2-year experience that frankly has changed the course of my life. And some of those people are still my very best friends. And just being part of that university was pretty incredible.
Oh, that's great. So then what was your, obviously working at the Endowment, you got a lot of experience with a lot of different asset classes. And so you go to graduate school. Where does your career lead you coming out of graduate school?
Yeah, I think I was already pretty focused on the investment side. I knew that was what interests me. And so once I was at Stanford, it was really about, okay, which asset class within investing is most interesting to me. And I knew pretty quickly that I wasn't a public markets person. I don't have the temperament. I think passion is actually the worst thing you could have when it comes to public markets investing. I knew that I needed something a little bit more tempered that I could really grab onto, get under the hood, and be part of kind of the change in the organization. So quickly, it was obvious that it would be kind of within the private equity or real estate realm. I went towards real estate during school and right after school because it was a hard asset, and that just made a lot of sense to me. And I found, I still find real estate fairly interesting, and we're all using it, touching it, and made a lot of sense to me. So I did go towards the real estate side when I was in school and out of school. But pretty quickly after, that was a large part of my career. I did that after school for about 10 years. And I loved it. And the people that gravitate towards real estate, they're the characters, and they're very real. And I learned a ton, but I quickly realized that there was a lot of other things within finance that I wanted to do. But in Stanford, I was pretty keenly focused on. Well, I was focused on two things. I was focused on real estate investing and my boyfriend. So those were kind of the two things that I was focused on.
That's hilarious. All right, so let's get into what you're doing today. I think we can move on to that and chat about what you have ventured into and the exciting things. You talk about leaning into passions. One of the things when I look at what you do in your current role today, it's investing in sports teams, marinas, and whiskey barrels. I mean, those are my three passions really in life. It's pretty incredible that what you're doing from the alternative side in your current business. To me, talk about leaning into passions. It kind of speaks to Sean Richland here.
That's what I was trying to do.
Thank you. It's working.
Yeah. Well, it's interesting because I think the question inherent is kind of like what led to this. I'm on this path of real estate, and how did I kind of end up in this area that we're very focused on differentiated things. After business school, I ended up going to a place called Makena Capital. And it was actually, we started the company there. So I was actually officially the first employee there. I was the first associate hired. I was actually the first employee, but then also the first associate. And then while there, worked on the real estate side. And by the time I left there, after 10 years, I was one of the 13 partners sitting around the table. And what I had seen over the course of my career on investing in alternatives, from Stanford Endowment to investing in real estate, McKenna, I just recognized that these kind of alternative asset classes, if you will, if you think of private equity, real estate, fixed income, the things that were less traditional, like fixed income and public equity, had kind of really run a lot of its course. So when I started investing in, when I was at the Stanford Endowment in early 2000, things were really alternative. When you invested in a hedge fund, or if you invested in private equity, it was very differentiated. And the whole reason of doing that, you were looking for kind of outsized returns that were uncorrelated to the rest of your portfolio. Because if you weren't going to get that, then you would just invest in public equity and fixed income. And so kind of the birth of like alternative asset classes was really happening when I was, in the early part of my career, and focused on those alternatives. But fast forward to 2014, when I was sitting at McKenna investing in real estate, that no longer felt like a alternative asset class. Frankly, it felt very mainstream. We could sit there would be 10 PPMs come across my desk. Do you want to invest in this fund? Do you want to invest in this asset? I had to do very little as of sourcing. I didn't have to do much of underwriting. And frankly, at the end of the day, was just buying the index. And the index was fairly correlated to all other asset classes. And this really came to fruition for us in the GFC. Once you notice that, I'm sitting in real estate, my colleagues sitting in hedge funds, and my other colleagues sitting in natural resources. And all of a sudden, after 2008, everything's correlated. We just spent 5 years flying on planes to make these investments that are supposed to act very different. And at the end of the day, they all acted the same. And so diversification was no longer kind of informing these portfolios. And so at McKenna, when I'm sitting on the real estate side, my colleague Gus was on natural resources and Gus was on hedge funds. We all said, you know what, maybe these things aren't alternative anymore. Maybe they really aren't generating the promise of diversification and high returns. And so we kind of coalesced around this idea that what if we really went back to the basics of what alternative investing was when we started our careers, which really at the time was proprietary sourcing, going out and find something that not everyone is doing. And so we said, well, wouldn't that be really powerful if we just created a firm that kind of went back to the basics of alternatives? So in 2014, after having been at McKenna for 10 years, the three of us decided to start our own firm. So we were 3 of 13 partners at McKenna, spun out to start Cordillera. And Sean, to your point, where it's ended is that we've invested in boat marinas, whiskey, sports, but we've also done environmental credits. We've done precious metal lending and leasing. We've done music royalties. And the common theme across them is not the same consumer. It's not the same structure. What it is that these things are uncorrelated to the broader economy, and we can kind of double click on that. And they are quote unquote pre-institutional. And frankly, I'm not sure if you are all aware of David Swensen. David Swensen wrote the book about pioneering portfolio management about 30 years ago that kind of set the stage for alternative investing. And his whole premise was you have to find things that are off the beaten path and don't act like everything else. And that was the premise between alternatives. Alternatives got much more mainstream, and so everyone had a private equity, real estate, natural resources, and just started investing in those. So in a lot of ways, what we felt like we were doing was going back to the basic of alternative investing. It happened, and and Sean, this was just fortuitous, that a lot of those areas happen to be on the side of leisure or of, and a lot of that is because when people are spending on those things, their elasticity is very different, right? They still spend on it even if the economy is going to hell, right? In fact, I would argue you spend more on whiskey when the economy is going south. So it is, but all that to say, I am probably a better investor at things that are interesting to me than things that are not interesting to me. So I don't know if it's a total chance that we end up in these areas.
Well, and I think it's interesting because you're going back to the genesis of the value creation that alternatives brought to a portfolio in being uncorrelated, which from a portfolio construction standpoint, you can't put a price on. Having something that's not going to move like everything else. And as these asset classes get more mature and more people exposure, I mean, you look at private credit, sometimes you're just getting a different type of credit risk. Like it's still credit risk. It's going to behave like credit, and the same with private equity. So
let's talk about uncorrelated returns though, quick, because I think that's really important. You mentioned let's double click into it. Let's do it. What's your philosophy as far as investing in these things that are uncorrelated? What are you looking for?
Yeah, well, taking a step back, let me give you just 2 seconds on why do you care about non-correlation? I mean, some people say, well, should I care about non-correlation? And I think anyone that's taken a finance class realize that's the one really free lunch is diversification and non-correlation. And we fundamentally believe that if you can generate returns when the rest of the market is crashing, then you can lean into areas, you'll have liquidity, and then you can actually even buy into the market that has just traded down. If all your assets are correlated and everything falls off, you don't have the money to then lean into value. And so really having assets that are uncorrelated really allows you to do that and protect your capital in a different way. So that's kind of the rationale for non-correlation. What are we looking for? I think we think about non-correlation in 2 ways. And this is challenging because it's on the private side. On the public side, you'll have a quant manager stand up here and give you all, the standard deviation, and then you'll give the coefficient and the correlation to that as a 0.2, and you can do analysis to determine correlation. On the private side, there's a little bit more of a subjective feeling towards it. So we kind of look at 2 factors that generate what we think is correlation. Number one, it's the drivers of return, right? So what is driving demand for this product, and is that correlated to the broader economy? So for instance, whiskey is always just a very good one. Are people going to drink less whiskey if the stock market goes down by 50%? Mm-hmm. And what the number suggests is no. In fact, you actually get kind of the opposite effect. So I would say the first thing that we're looking at is, do the drivers of return of this asset, this company, correlate with the broader economy? That's the first thing that we're looking for. The second thing is there's just a reality that if you have a time period where you need to monetize an investment and you just happen to be exposed to 2008 or 2022, and you need to sell something at that time, you have correlation risk because less people have capital. And so you need to be very careful, and we always call that vintage year correlation, because you could have the right idea, but if you need liquidity when the world has no liquidity, you probably have more correlation than you think. So we are trying to quantify both of those when we think about a given investment. And I'm happy to talk about when we talk about those investments, how we actually determine and assess that non-correlation.
We talk a lot about this as well with on our daily lives about when you retire. People say, "Oh, be a long-term investor, be a long-term investor." But if you retire at the wrong time and you start taking money out of your portfolio, things get very different fast. And how do you stick to the plan that you've been building for a long time? So it makes sense what you're saying right now as far as the vintage year correlation. Absolutely.
Yep. So that's, I would say that's the first thing we look at. And then the second qualifier is something capitalized or undercapitalized, because I think a lot of people talk about non-correlation. And in order to get non-correlation, you have to give up return. I mean, that's what we've seen in the capital markets. You have a lot of the hedge funds that are saying, okay, we'll give you a 5, 6, 7, 8% return if you want non-correlation. It's expensive in a lot of respects. And our whole theory is, no, you can actually find non-correlation and not have to give up return if you're not where all the other capital is. And so that second component of looking at something through the lens of, okay, is this uncorrelated and is it undercapitalized? And so that's kind of that idea of being, in finance terms, inefficient, that we can still find some inefficiencies in the world if you start to look where the rest of the capital is not. And the reason we care about that is that we think we can still get return and non-correlation. So what we're just trying to do, and we don't care what strategy it's in, we're just trying to get high rates of return and non-correlation. It happens to be in everything that Sean Richland likes to do.
I mean, this is amazing.
It's incredible.
It really is. So let's talk about one of those things I like. So let's talk about sports and investing. And we've seen a massive shift into this space from private equity, being able to invest, getting approved to invest. And on the bigger scale, so let's look at the 4 majors, the NHL, which is probably the most important one, the NFL. No?
No,
Well,
definitely
not by audience.
Oh,
Yeah,
so
yeah,
Yeah.
but maybe by your passions.
Okay,
She
Yeah.
said follow your passions.
I'm following my passions.
Yeah,
Yeah.
it'll work out.
The MLB
Huge enough.
and who am I leaving out? The NFL, that's a big one. And a lot of the families that own these sports teams have issues with cash flow because they have owned these teams forever. The valuations have gone crazy. They've never been able to take money out, and now private equity is coming in the larger scale to give them liquidity. Is that a fair assessment?
Yeah, that's exactly right.
And I think they can't have debt. That's
Yeah, a lot of them cannot. And also a lot of them have caps on private institutional ownership. Two things. Yep.
And so we're seeing a massive rise with the huge funds going into there, but there also is, in certain circumstances, opportunities outside of the big 4, NHL being the most important, of the private equity coming in and starting to invest in these sports leagues, teams, even events. There's lots of things out there going on, and what are the tailwinds you're seeing out there right now for uncorrelated type of investments?
Well, I think before we get into that too, I'd add that the media landscape has changed so much.
What do you mean
that
by
a lot of these sports, like we talked about F1 with our last guest, and how much value they've been able to create in F1 just as a result of their branding and their media and the clips and
Yeah. And I can double click on that a bit because I think that's pretty interesting and relevant to our strategy. But taking maybe a step back and addressing Sean's first question, and the question is why are institutions going into these spaces, given kind of where valuations are today? It's because of the number one thing is that they have proven to be uncorrelated. So if you look at the 4 majors, being NHL, NHL, NHL,
Yes.
and NHL.
Now we're getting
You
on to
realize that since 1960, they have a 0.2 correlation to the index. I mean, that's incredibly valuable. So, and the point there is, Sean, when you're about to retire next year, if you had just put your money into that, it could be compounding over that period of time and be very uncorrelated to everything else, which is it's very profound. And if you have compounding returns on uncorrelated assets, it's pretty powerful what it can do for your portfolio. And so institutions have taken note of that. And so that has been a large reason that they have come into the space. And so just kind of the whole premise of why those investors are coming into the space is consistent with what we're doing. So if, again, I go back to the 2 pillars that we look through, one, non-correlation checks the box. And that's because at the end of the day, do you care what's happening with the S&P when you're watching your NHL team or your football team or your baseball team? No one cares. that's still something you do. We can get back to the media side because Jason, I would argue that does have some correlation. But the point is that these things have proven to be uncorrelated over time. That's one of the things that Cordillera looks at, checks the box. The second one is the pre-institutional nature of things. And Sean, you kind of hit it on the head. We would not be in the big four. There's one, they don't need our capital. And two, there's other capital that have really bid up pricing. And so kind of that second pillar, we're trying to generate outsized returns. That's harder to do when you're buying in at valuations like some of these teams are buying in at. It's very hard to get a 20% return on a forward basis. So we, since our inception, have always kind of looked beyond the top four. And so what that's really resulted in is we have really three pillars within sports that we look at. The first is emerging leagues and emerging teams. And we have an example of this. We invested a few years ago in the Professional Triathlon Organization. And this is kind of has everything to, it's like the Formula One of triathlons, where they go around to various jurisdictions and have a event. What we like about that is it's not just an event like F1, it's mass participation on that event. So you don't just have drivers, you have 20,000 to 100,000 people actually competing in the event.
There's that many people who want to do this? Really?
Masochists.
Oh my God.
It's unbelievable. And my co-founder is one of them. He's actually in Dubai as we speak at one of the PTO races. And needless to say, I did not underwrite that transaction.
Oh my word. Could you imagine? That is just, there's so many people that love to run, swim, and bike forever.
Well,
and you know what's interesting about them, Sean? Not only a lot of them, they're all affluent, which is actually a big deal when it comes to our underwriting, because the sponsors come in there in a different way. You know, sponsorship has always been so tied to the media dollars, right? So sponsors follow media. In this case, we don't even need the media rights. This is just about the sponsor saying, you have 20,000 people competing in this event that have an average income over $200,000.
Well, it makes sense. To train that much, you got to have capital. I mean, it's insane,
and time,
right? And you also got to be a little crazy. You
Yeah,
got to like the pain. There's just no
but
chance.
I'm sure there's no crazy people in hockey.
No, they're very crazy. But I just
goalies, right?
I was so happy to be
goalies are crazy.
I was so happy to be done running. Oh my God, when I was done with Michigan.
I know.
Oh,
I know.
the worst.
I hear that.
Fascinating.
So anyway, that's the first pillar. And we think there's a lot of, and so to your question of what's kind of driving that side of these emerging leagues, there's just a lot of demand for these ancillary sports, and there has not been capital that has kind of created the infrastructure. So what we're always trying to do is find where there's latent demand, and triathlons is a perfect example of this. They just haven't had a professional organization supporting it. So we're providing the capital to support that league. So that's kind of one pillar, if you will. The second is women's, which I could probably speak ad nauseum about. And then I'll just talk about that because I'll come back to that one. But the third one is kind of the picks and shovel supporting sports. So I don't think you're going to see less private equity entering the space over the next 10 years. In fact, I think you're going to see more. And what we're looking for is kind of the businesses supporting that growth and investing in those. For instance, we're investing in a law firm in the UK, which you can do in the UK, you can't do in the States, that is 100% focused on sports. It's the predominant boutique firm in the UK that is focused on, football, rugby, cricket. And so we've seen kind of their business is very levered to the beta of sports investing. And so that's an area that we'll lean into. And then on the women's side, really the tailwinds supporting that is that we've seen, apparently women's sports is going to hit $2.5 billion worth of revenue this year, which is up about 300% from just a few years ago. So there's a lot of tailwinds supporting that, but I would say it's still very nascent from a valuation and a commercialization perspective. So we think that pillar is very interesting.
For women's sports, you think about the growth perspective of the company. Like, you think of volleyball alone, and you look at what's happening at Nebraska.
Oh yeah, they're like selling out the football stadium too.
How is there not a professional women's volleyball sport that
there are?
I think there are
that have grown to be.
I've seen them on TV.
The WNBA has done. Like, to me, it's a no-brainer. That's going to take off. And how many young girls play volleyball? I mean, it's insane around here.
Yeah, it's the number one youth sport for women.
Is it?
And followed by soccer. Yeah.
I love it.
Yeah, I can see that. And then, outside of even women's sports, there's all these other like padel and how that caught fire, and like all these crazy sports we never thought of before.
Padel.
Yeah.
They built that big one. Zetterberg built that big one here in town in Detroit. Smash Padel. I was walking in San Francisco and downtown, and they had a Padel. Where was I?
The Ferry Building.
Yes, in the Ferry Building, right there. Yeah, it was sitting there.
Phenomenal.
We should go back to the tried and true sports like rackets or real tennis.
Here we go. Here we go. Jason Sports. Jason plays polo, for the record, for those of you who are polo fans. Not like water polo, like when you're actually on a horse.
Oh, like straight up polo, like on a horse.
Yes, we could use a sponsor. Is Cordillera interested?
So you remember the first thing I said? Latent demand.
Oh, shoot.
We are not a let's build it, they will come kind of shop.
Fair enough.
Yeah, it's a good cheap sport, too. You only need to have how many horses?
I mean, it depends on what level you're playing, but it's definitely more than one per player. It adds up quickly.
There you go. Mm-hmm.
Yeah.
Good luck. All right, so let's move along into other things that Sean enjoys. Marinas. I'm fascinated by this because as I was looking through how to invest in or what you guys are investing in marinas, I was like, what, are they going to do in salt water, fresh water? Is there like a thing to think about here because of the wear and tear on these things? And doing the non-correlation, I can see why, because we as a family during COVID, we spent so much time at marinas and boating. So I don't know. Talk a little bit about the marina side of it as well.
Yeah, no, you're absolutely right. This is something that we started looking at in 2015. It was actually our first investment. And what we found is a few things. One, the institutions were not in the space. And the result of that is that you could buy these things for incredibly attractive prices for the amount of earnings that they were throwing off. And that is the form of a cap rate. So these things were trading at, north of an 8% cap rate, 9% cap rate, when everything else in real estate at the time in 2015 was trading at sub 5%, 4%, 3%. So there was a huge delta between what property types like mainstream real estate was trading for and what you could buy a marina for. And so then we said, okay, well, is there a reason for that, right? So when we get into these areas that are niche off the beaten path, they're either niche off the beaten path because they're not understood or because they're horrendous ideas. And so we're always kind of balancing, is this a horrendous idea or is it just overlooked for some reason? And what we found is that the earnings, so the second pillar, the earnings of these things were incredibly, incredibly stable. And so even though, and I think this is a little counterintuitive, when we first said that, we're like, boating, well, that's got to be pro-cyclical. I mean, that's, who buys a boat? And you only buy a boat if the economy's going well, right? But what we found is that at the end of the day, even if people aren't using their boats, they need a place to park it. And two, if you don't pay your rental on your boat marina, they can take your boat. So there's a real reason to pay. And so what we found during the GFC is that earnings for these boat marinas were incredibly stable, despite the fact that boat sales went off a cliff. And so that kind of fit our, oh, that's interesting, this is uncorrelated. And number two, we're getting this at a very, very attractive price relative to other things in real estate. And so in 2015, that's exactly what we did. And we bought a portfolio of these things. And there's a lot of reasons that having a portfolio of these things really reduce your risks and allows you to get attractive debt. But we've owned that asset, or we've owned that company since 2015, and it's been a really interesting company. And through periods of, everything's happened since 2015. We've had COVID, to your point, Sean.
Yep.
It performed incredibly well. We've had the inflationary period that's performed well, and then we've had periods in contraction. And again, speaking to this non-correlation, holding this in our portfolio when everything else was kind of falling off the cliff, it was very nice to know that we just had this asset that continued to grow and continue to add value. And that's, again, what we're trying to do.
And there's boat clubs all across the country now you can join that have to fill up marinas, like Freedom Boat Club and different things like that, where you can utilize it as a consumer, but they take up 16 slips, I think, in little tiny marina here.
Well, and I've seen it with the demand for just slips in general. I mean, I don't know if you call them dealerships or wherever you buy the boat from, whatever they're
brokers.
Boat brokers, but they're sweetening the pot by, if you buy a boat from them, they have a guaranteed slip for you.
Oh,
Yeah.
There you go.
Well, and I think the stat is for every 8 boats, there's 1 slip in our country. So that's how undersupplied we are. So that is a pretty good incentive to be able to get a slip when you buy a boat.
So again, uncorrelated, right? Passion, uncorrelated passion.
Cash flows too.
Seems like I'm an uncorrelated.
I want to have cash flows.
In my leisure life, I'm very uncorrelated, I feel like.
I would think you're pretty correlated.
I'm pretty correlated. All right, let's move on to whiskey.
The amount of groupthink in your circle is probably pretty high,
like,
Sean.
Yeah, I would agree.
It's high beta. I think it's high beta.
Let's move on to the last piece here of our passions, whiskey. And I've always been curious, and we hear a lot about investing in wine, alcohol, whiskey, all the things. Tequila now is huge. You've heard about all these great stories of whether it's Clooney or who's the country singer, George Strait. A lot of people have come out in the spirit
Charles
space.
Woodson.
Charles Woodson. That's where I actually have the Intercept wine at home. Just so you know. Yes, I do. I don't have his whiskey though. I got to get it. Or is he?
No.
He's whiskey or bourbon? He's whiskey, right?
He's whiskey.
Yeah.
He's whiskey. It's not in Kentucky.
Pardon me?
It's not in Kentucky.
Oh, that's right.
It's bourbon.
There you go. There you go. So let's jump into whiskey a little bit and see how that fits into the old ecosystem of your firm.
Yeah. So this is another one that we've been doing since 2000. This one we started in 2018, and our whole strategy was to buy new fill whiskey, which is essentially moonshine. So it's right off the still, clear, put it in barrels. We buy it then, we hold it for 4 years, and we sell it at what we call in the business a pricing curve. And we sell it to craft brands for, whatever return that is. The reason that there's an opportunity that exists within whiskey is because there's two things. One, the bourbon boom has created a tremendous amount of demand. We've been in a bourbon boom since early 2000s. Some equate it to Mad Men. And so there's significant demand that has been growing, and there's a lack of supply to fill that demand. And so that's one reason that there's an opportunity. The second is that there's an aging requirement for whiskey. You probably know this because you're probably a whiskey drinker, but essentially if you age whiskey less than 4 years, you have to put an age stamp on the bottle, and that is assumed to be not as good as whiskey. And so there's a 4-year cutoff where you don't have to put that age stamp. So what you see there is that if you're a craft brand and you want to be a higher end, you're going to want to age your whiskey 4 years. But you as a craft brand and either a startup or someone that doesn't have a lot of time or capital, you don't have the ability to sit on whiskey for 4 years. So we love to find areas kind of within a supply chain that needs patient capital. We're patient capital. We have long-term capital. We can hold it. So all we do is we go buy it when it's right off the still, tastes like moonshine. We store it, pay insurance on it, don't even have to take possession. We just keep it at the rick house of where it was stilled. And then we sell it to the prevailing craft brand at a profit. And because that we have this patient capital, this opportunity exists. So it's a very simple strategy. It's one that's, it's not as pronounced today because there has been more supply come online. And some would argue that the demand side of the equation has faltered, not in Michigan as much as other parts of the country. But this, so there, I would say that the trade, if you will, isn't as pronounced, but it's still interesting. And there's still an ability to provide this kind of patient capital. It's uncorrelated because at the end of the day, so going back to our 2 pillars, uncorrelated. People do not drink whiskey relative to what's happening in the S&P. So that's really important. And 2, because of the supply demand imbalance and this aging requirement, we can get outsized returns. So it's, again, those combination, high rates of return, uncorrelated, compounding in your portfolio is going to de-risk your portfolio overall. If you just hold a bunch of stocks, a bunch of bonds, it's really nice to have something that's going to act very different within your portfolio. And that's whiskey. And then if it all fails, you can just drink it.
That's right.
All right. So yeah, there's a fallback plan.
There is a fallback.
That's okay too. So you see all these craft distilleries, and it's fascinating, but you can tell why when they launch, it's usually a vodka or a gin. It's never a whiskey because of the aging requirements.
Oh,
that's right.
Interesting.
Yep. Exactly right.
Really?
And Woodson, you have to say Woodson has taken he is selling younger age whiskey.
Okay.
So he has kind of taken that requirement out.
And that's what's crazy. She mentioned it, but when it goes into the barrel, so if we take bourbon, for example, it goes into the barrel, it's clear. And it's the charred oak barrel is what's giving you that coloration.
I've never done the Bourbon Trail. I got to do that.
Oh,
Put that on our list, Charlie. Our producer.
It's an easy
Charlie.
drive. And you can stop
it's
at
actually
Buc-ee's.
interesting. Yeah, we do. One of our things is, when you invest in Cordillera, you have to be like-minded in a way that you recognize that you like things that are differentiated. And so at our annual meetings, we do try to create, kind of curate this like learning, and the investors themselves are very curious and differentiated and think about it differently. And we've done it in Kentucky 3 times. So 3 out of the past 7 years, we've done it on the Bourbon Trail. And it's just fascinating to understand the business of whiskey, the various different components of it. And then actually the other component within Kentucky is the horse racing, which is also incredibly interesting. And so we've done our annual meetings there the past 3 years, and we'll probably do it again. So you'll have to come back. But the education of it is it's fascinating business.
Jason, you get a horse maybe, and you can have some bourbon or whiskey.
It's a great idea.
Yeah.
I'm kind of curious about these rick houses that are storing all the barrels. I mean, they have like 20,000 barrels of whiskey aging in them.
Yeah, it's phenomenal. I mean, when you walk in there, you probably saw it on the show, but you walk in there and it's just rows and rows of these barrels. And frankly, that the insurance side of things is a very important aspect of it. There's been a lot of fires within these rick houses. In fact, Jim Beam had a big one. I think it was about 3 years ago, and insurance skyrocketed. And so that is actually a component, the safety of your barrels as you're aging them. And that's actually a very important component of the whole thing.
Yeah, I mean, it's
storing
a flammable liquid in an old wood building. What could go wrong?
Absolutely nothing.
What could possibly go wrong here?
So if we transition a little bit, we're talking about those 3 niches and kind of Cordillera and what you're focused on and why there's outsized returns in those niche markets that are interesting and not oversaturated. If we think about our audience of financial advisors, what would be some kind of takeaways? Obviously, the uncorrelation is a great takeaway when doing portfolio completion, but any other takeaways for advisors?
Yeah, I think the perception when we started this was that you're doing weird things, they must be riskier, and I think that's interesting, and it's we think about risk often, and I think one of the things that advisors, investors, private equity, and alike underappreciate is basis risk, meaning pricing risk. And when you're in competitive markets like private equity, yes, you might not be taking on some of the risks that we're taking on, but when you're buying in at multiples, north of 20 times, you're creating very little margin of error. So one of the things that we're also saying by doing what we're doing and staying off the beaten path is that we can buy in things on a relatively, I don't want to say cheap, that it has bad, but at a value. And because we're not competing with others. And that value allows us kind of a margin of error that I think people underappreciate when they're competing in these kind of quote unquote markets today that are so competitive that you have very, very little room in order to be able to execute on your business plan. And kind of when you get off the beaten path, you can dictate terms through pricing. The other one is structuring. So a lot of times, because we're the only capital surrounding these things, we can create real downside protection, either through collateralization, and then we can also create additional upside opportunities through having warrants in the business, or creating stronger governance around a management team, or creating better terms to ourselves. So I think there's a lot of benefits about getting off the beaten path. And that just because we're doing these things that are differentiated, it doesn't necessarily mean that the risk net is higher. Are we taking risks? Absolutely. It's just very different risk than is already in your portfolio. And so I think that's another thing that when people kind of dig in, they recognize like, oh, this doesn't just have to be riskier. It actually could make a lot of sense, and actually in some cases be less risky.
Right. You're applying traditional kind of underwriting to a business that's just not thought of in that way.
Yeah, yes, that's exactly right. And in fact, in a lot of ways, because we're afforded the time. A lot of these things that we can underwrite for a year. So we're a pretty concentrated portfolio. We have to afford ourselves the time to really understand and underwrite these things. Having time to underwrite is very much a luxury, particularly in a competitive market. And again, I think that oftentimes can de-risk an opportunity.
What do you think about when we were I'm looking at our rundown here, Jason, and why now is an attractive environment for alternative and specialty exposures? I think that's something I've been thinking about a lot. What's your take on that? Why now?
So I want to say, we think of ours as a secular and cyclical play, but the secular part is that just what we've already said is if you put a high rate of return with low correlation and even the same amount of risk, if you put that in your portfolio, you're going to push out your efficient frontier, which we all know is the and that could happen at any point in any cycle. So I would say there's an always on reason to be investing in non-correlated high returning investments. But in this particular moment, when the S&P is trading at north of 20 times, and both on the kind of international and domestic side, just valuations are incredibly high. And so getting off the beaten path and finding things where you don't have to pay that type of multiple just allows you to afford yourself that opportunity to you don't have to get things exactly right, and finding value is incredibly important. So I do think there is, I don't want to overemphasize the cyclical moment, but it's there. So I'll emphasize it. People always come to us and they, when people want to invest in us is when the market has fallen off 30%. And I say, well, you should have invested when the market was up 30%.
Right.
And so that's now, but I do have to say, people in the finance world, myself included, we have short memories. And, when you've gone through a long beta run, you forget the reason for diversification until, frankly, sometimes it's too late.
Do you want my thoughts on this, Sean?
No. So you just essentially, our host here, Jason Johns, has been preaching pretty much what you've been saying. I call him a dark cloud because he's like, it's so overvalued. But it does make sense.
Well, that's the benefits of having truly uncorrelated assets, which are hard to find, to Ashley's credit, because they really punch above their weight from an efficiency standpoint in your portfolio.
Yes, this is true.
And Sean, I do think, for investment advisors, historically, you've had to give up returns in order to get non-correlation. So it's a tough decision, like, okay, I want non-correlation, and so I'm going to have to get a 5% return through reinsurance or something like that. We're saying you don't have to. You don't have to give up return. This is kind of, you get your cake and eat it too. And so, if we can give you returns, and be uncorrelated, then it's not a tough decision, right? Then, then everyone should have that type of product in the portfolio if it exists. The harder is, wait, do I have to give up return in order to get non-correlation? And that's really hard to do. And I understand the aversion to do that.
Right. That makes sense. Totally. Well, we've taken a lot of your time, Ashley. We appreciate the insight. It's been incredible to reconnect, and we have a few last questions for you.
Well, it was a fascinating conversation. I'm glad we had this, but we do tend to end with some rapid-fire questions. I'm going to kick off the first one, although I know what your answer is going to be.
You do?
And that is best game day environment, Michigan or Stanford?
Oh, that's there's no, do you like a sports environment or a country club? You got to go Michigan 100% of the time.
Yeah.
Although it makes it a little tougher over the past couple of days to say that.
Yeah.
But
right.
yeah, Michigan.
Moving on.
Moving on.
Whiskey or wine?
Whiskey.
All right. Let's see if she invests in whiskey. I figured that was going to happen.
Right. Most underrated sport.
Ooh.
Oh, that's tough. I'm gonna have to go underrated or undervalued. Underrated.
Underrated. Broad public appeal rather than investment appeal.
I'm gonna have to go paddle.
Yeah, it is taking it off. This is Jason. You should ask this question. The next one.
Which has the deeper moat, Marina or whiskey?
Marina.
Interesting. All right, one market today that you wish you were invested in right now.
I mean, personally, AI. I wish I'd been invested about 20 years ago.
Yeah, you were there, though. I mean, you were in the Bay Area.
You're
in Stanford.
I know. I have
Palo
no
Alto.
excuse. I have zero excuse. Now, yeah.
Didn't see the writing on the wall.
I did not. I was scared, head in the sand.
Yeah, well, it's all part of it, right? It's part of the learning, the passion. It's been a great to catch up, and a couple of things. My takeaways. It's just lean into your passion. I think that's such a great thing to as a young person going through college sports, like you and I both did, or just graduate from college if you're not playing sports, whatever. Lean into what you love, and you'll find your way. And I think that's great advice.
I would agree, and it's interesting how some people will say that's bad advice. Although she wanted to do the hard thing. I think that helped her career too, and then the passion.
It's fair.
What's the hardest thing to do right now?
Yeah,
so a lot of college grads aren't asking that question.
No, they're not. I happen to be a little bit of a glutton for punishment, but I think it is helpful when what your passion is challenging yourself. So I think that was fortuitous for me.
All right. Well, this has been great, Ashley. I really appreciate your time. Loved hearing about your investment thesis and kind of the niche aspect that Cordillera is focusing on. I think this was a fun conversation.
This was great, guys. Appreciate your time.
Yeah, thanks so much for coming on. It's great to see you. Have a great weekend.
Take care, guys. Go Blue.
Go Blue.